home equity line of credit is a line of credit that uses the equity in your home as collateral. For example, if you're following along on screen, let's say that we have a homeowner who has a home that's valued at $400,000 and the mortgage on that home is $280,000. Well, most lenders are going to look at a home and they're going to take a certain percentage of that home's value. In most cases, you'll find that to be 80%, and they're going to subtract the mortgage balance to calculate your available line of credit. So in our example, if we take 80% of our $400,000 home value, that would be $320,000. And if we subtract our $280,000 mortgage balance, that would leave us with an available home equity line of credit of $40,000. Now, when it comes to the calculation percentage, you will find that 80% is typically the standard in normal times, but there will be times where interest rates in the general economy are higher or lower, and maybe during those periods, a lender will give you access to less of your home's loan to value, say 65 or 70 or 75%, or there may be periods where they give you more of your home's loan to value, like 85 or 89%. You will also see that if you have a home whose value is above a certain number, that they will typically give you access to less of the home's equities. So for example, if you looked a couple years ago, if you had a home that was valued below $1 million, a lender may have given you access to up to 89% of your home's loan to value, whereas if you had a home that was above $1 million, they would stop you at 80%. So they're essentially saying we don't want to have these super high priced homes in a position where the homeowners can access just these really large amounts of equity. The higher the value of your home, the less of the percentage they will give you on a home equity line of credit. And when it comes to the structure of your home equity line of credit, when it comes to repayment, when it comes to taxes and other different types of debt, it straddles the fence between what we call installment debt and revolving debt. You see, installment debt is debt that you have access to for a certain period of time. 10 years, 15 years, 20 years. And during that period of time, you can borrow the funds one time and you have to pay what you've borrowed off in full by the end of the period. An example of installment debt would be a mortgage. It would be a student loan. It would be a car loan where you buy a car for $50,000. You're repaying it over 7 years. You borrow the money for that car one time and you have to have paid off what you borrowed by the end of the 7-year period. And when it comes to installment debt, you have to understand that first, it does not impact your credit utilization. Credit utilization being an element of your FICO score that constitutes 30% of your score. But it is not impacted by what you owe on installment debt. And in addition, you will find that with many forms of installment debt, pending certain things like the amount of your adjusted gross income, you can in some cases benefit from tax deductions that are associated with your installment debt. For example, if you own a home, we've talked about if you itemize your taxes, being able to deduct the interest that you pay on that mortgage. There are also scenarios where if you earn below a certain amount of money, you can deduct certain portions of your student loan payment. That's installment debt. Home equity lines of credit are like installment debt because they do not impact your credit utilization like a credit card would, but they also have a limited period of time in which you can borrow the funds, like 5 or 10 years. Unlike installment debt, however, a home equity line of credit gives you access to that amount of money and you can borrow the funds over and over and over again. So if you have the $40,000 line of credit like in our example, you're not limited to borrowing it one time. You don't even have to borrow it at all. If you have an open $40,000 line of credit and you choose not to borrow the money, then you don't owe anything. But if you do borrow the money, you can borrow it, pay it down, and go borrow it again. That is what it's like to be a revolving debt. And a revolving debt is like a credit card where you have, say, a $10,000 credit limit. You can borrow the $10,000, pay it off, and then go borrow the $10,000 again. Revolving debt like a credit card does impact your credit utilization. So if you borrow $10,000 on a $10,000 credit limit, then you have a 100% utilization ratio, which would wreck your credit. And also with many forms of revolving debt, there is no limited period of time in which you can borrow the funds. If you have a credit card, unless you act adversely with that credit card, you can keep it open for the rest of your life. But as we covered with the HELOC, that's not the case. It has the installment portion in terms of how long you can borrow the funds, like with installment debt, and it has the ability to borrow the funds over and over again, like you would find with the revolving debt.